Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro. Thank you very much for listening to this video today, and as usual, please don't forget to smash that like and then to subscribe to my channel. That would be super appreciated. So guys, in today's video, I'm going to be talking about mainly what happened in the markets last week. I'm going to be going over several key areas, as well as talking a little bit more about our portfolio performance and some of the news from last week. So let's get started. So last week, our portfolio performed pretty well again, and our portfolio was up about 3.79% for the week. And that was mainly because the S&P and the Nasdaq had a great bounce back from the previous week, in which it fell quite significantly. It was a good bounce back there from the mainly from US stocks, especially those in the tech sector. And then Europe and China didn't perform very well last week, and they've continued to falter over the last couple of weeks, mainly because of the banking crisis, especially has affected Europe now, and China, and the relations and the tensions with the US has caused some of the Chinese stocks to falter as well recently. Also, if we look at Bitcoin, had a really huge, spectacular rally over the last couple of weeks. It's actually up over 22% overall for the week. And that is because Bitcoin has really been seen as a flight to safety, especially with all the banks going down. Really, that's Bitcoin came out of the financial crisis of 2008, 2009. And it was really kind of made for this type of environment. So what we're seeing is we're seeing people with very large balances in the US. They're very worried about the savings being inflated away, but they're also very worried about getting access to the fiat dollars if the banking crisis continues to get worse. So we're seeing a lot of money flowing into Bitcoin, slightly less into the altcoins, but I still think we are in a risk-off market at the moment. If we look at other commodities, gold actually did pretty well last week, as well as silver, so they were kind of good hedges in our portfolio. However, oil and natural gas have showed some weakness, and that is mainly because as the potential for a recession increases, the likely demand of oil and natural gas does decrease as well. So there has been some weakness overall in oil and natural gas. I also did many trades last week very successfully. So last week I did many trades in oil as it went to yearly lows. And it's a very good time for me to do those types of trades, either when we're in yearly lows or at yearly highs, and I can either go long or short depending on the situation. So I've actually done over 50 oil trades now over the last kind of year and a half or so, and I'm 100% profitable on my oil trades. So they are working out very well for me. I also have had various short positions on European indices over the last kind of couple of weeks. And last week I did some successful shorting of those indices in the UK 100, which is the FTSE 100, ESP35, which is basically the Spanish IBEX index, and the German 40, which is the German index of the top 40 stocks in the German market. Those were all closed in profit, and they really helped me to, despite a tough week for bank stocks and some other areas, those really did help me to turn around a good profit overall for the week. So if we look at that compared to a benchmark, the Nasdaq was up about 4.4%. And that mainly outperformed because it has a very high makeup of technology stocks. And as there is growing optimism, I guess, that the interest rates might start to reduce as early as June, this means that a lot of the tech stocks have rallied on the hope of lower interest rates moving forward. We also saw the S&P 500, which was up about 1.4%, which we outperformed. And it was an extremely tough week for the FTSE 100 in the UK last week, and that was down about 5.33%. And the reason why the FTSE 100 has suffered so much over the last week or two is, I have mentioned this before in my videos and my interviews, but the FTSE 100 is made up of a large proportion of financial services stocks, mainly banks. And because it has a high concentration, there's been lots of fears around the banks and liquidity, etc. That has meant that the FTSE 100 has fallen quite dramatically, especially as it was quite a high level previously to this bank crisis. And then Bitcoin, as I mentioned, has been up about 22% this week. If we look at our performance on 2023 on a year-to-date basis, our portfolio is up about 14.4%, which I'm very pleased at. And I'm very pleased to say that we're outperforming all the other indices this year. Nasdaq is up about 11.1%. The S&P 500 is only up 2% overall for the year. The FTSE 100 is down for the year about 1.56, mainly because of those recent slump in the last week or two. And then the Seng index, which is the Hong Kong index, is down about 3.85%, in which we do have quite a high amount of Chinese stocks within our portfolio. So Bitcoin is up quite significantly for the year as well, and it's been a very good performance for Bitcoin and for other altcoins so far in 2023, and I see that continuing, but I will talk about that a little bit later in the crypto section. So as I go over the main news for last week, well, as I mentioned, shares bounced back on the Nasdaq and the S&P 500 after a really poor week last week, the week before. And then the mega cap tech stocks generated significant free cash flow and have minimal exposure to regional banks performed especially well. And large cap growth stocks outperformed their value counterparts. So as I mentioned, as there is more expectations that interest rates may start to drop a lot sooner than had previously been expected, and the expectations of the next FOMC meeting have decreased in terms of the interest rate hikes, or whether they'll freeze them altogether. So there is more expectations that interest rates could go down quicker than expected, which is obviously very good for tech stocks. We also saw regional bank contagion worries intensify, and there was a lot of people saying, well, could after the bank issues that we've had with Silicon Valley Bank, and we also had with Silvergate and other such banks, Signature Bank is another one, could First Republic be the next to go down? And very recently, there have been major banks have deposited $30 billion with First Republic to relieve some of that balance sheet fear. So there was a real fear there that First Republic could also have been the next one to go under. However, they have been supported by many of the major banks, which I really think that actually the major banks are benefiting from this in the long term, because a lot of these regional banks are having extreme troubles, and as people rush to withdraw their money, they're kind of forced to put their money into much larger banks where they have a lot more assurance that they're going to be able to get their money. So we are seeing that kind of move from some of the regional banks to people having bigger accounts at some of the larger banks. And I think we're going to see a lot of consolidation in the banking industry. And I think some of the top banks are going to benefit by getting some of these banks at a very low fee and taking their customers. We also seen that at the forthcoming FOMC meeting, which is in the next kind of week or two, the expectations of previously of 0.5% interest rate hike, that was firmly on the table just a couple of weeks ago, and that was actually the expected result. However, now 0.5% interest rate hikes in light of what's happening with the banking crisis has been taken completely off the table, and there's now being priced in almost a 0% chance of that happening. And we're even seeing now, although 0.25% hike is the most likely scenario, we're seeing that the chances of no hike whatsoever has increased now to 39%. So that is quite significant, and that is rising. And I think the more banks that we have that are showing signs of struggling, I think the less likely they are going to be to increase those interest rates further at the next FOMC meeting. So we'll keep an eye on that, but they're also going to be very swung by what is happening in Europe. The policymakers talk to each other. In Europe, last week, they raised their rates by 0.5% at the recent meeting to try and lower inflation. So there's going to be some pressure on the US to also at least make a gesture of increasing those interest rates. We also saw the CPI results last week were released, and it showed that it was 6% for the year, which ended in February, and that is down from January's 6.4% and in line with economists' expectations. So that really did help to rally the market. And it is showing signs that the Fed do have inflation under control at the moment. We'll see what obviously happens with these banks, etc. But they seem to be making significant inroads anyway to reducing the inflation number. However, obviously, there's a lagging effect, and sometimes those rates need to be held in the market to make sure that you can hold on to reducing that inflation. And that is the 8th consecutive month that annual rate has declined and actually marked the lowest level since 2021. So quite good progress. Obviously in Europe last week as well, we also did see the failure of Credit Suisse, and the Switzerland government had to come in to backstop customers' funds. And it's just been announced that UBS has agreed to acquire Credit Suisse. And there was some talk that maybe it might have to be nationalized, etc. But UBS have swooped in to support Credit Suisse. However, obviously the Credit Suisse issue in the market did cause significant downturn in the banking sector, both in Europe and in the US. Also, we saw the central bank's projections in the ECB. They put average inflation at 5.3% in 2023, so obviously showing a good reduction in inflation, and then they expect that to go down to about 2.1% in 2025. So that's their projections that are going to slowly increase the inflation rate as interest rates rise. But it's again to be seen whether the banks in Europe can actually sustain those higher interest rates. We also saw the UK jobless rate remain unchanged, and it's near a record low of 3.7%. So again, we're seeing a very strong jobs market and very low unemployment in historic levels. And this is really shown in a lot of the inflation data. Okay, oil's come down, the price of housing has also started to reduce as those interest rates have gone up, but however, we are still seeing a very sticky inflation number in terms of the services sector. And the services sector, as you know, requires lots of jobs, and this helps to reduce the unemployment rate. We've also seen the People's Bank of China has said that it will cut the reserve requirement ratio for most of its banks by 25 basis points. And this is the first time this year that they have reduced that reserve requirement ratio rate. And what this does really is provide more liquidity around the market. It requires the banks to hold less funds, and then that can then be spent in the economy. So as we are seeing in the US, we're seeing that Interest rates are rising, and it's still quantitative tightening. However, in China, they are doing the opposite, and we're seeing a lot of quantitative easing. We've also seen in China, over the last couple of years, we've seen Chinese house prices have gone down significantly after the big bubble that we had for the previous 10 years before that. And now we're starting to see signs, especially in the largest cities in China, that the prices rose about 0.3% in February, and that's above the 0.1% gain in January, and then obviously the losses last year. So this is the fastest increase since July 2021. So there is hope that the Chinese real estate market has started or has already bottomed. So as we move on to our top 3 performing stocks of last week, and our top performing stock for last week was Coinbase, which was up about 40.31%. That is mainly because of the great year that crypto has had so far, and the fast start to 2023 that crypto has had, especially as Bitcoin has continued to rise. This means that more people are trading on exchanges, and this means activity's up and they can charge more transaction fees. So this is very positive overall for Coinbase. So seen a nice bounce back after a really terrible late year last year for Coinbase. Also, the second best performing stock in our portfolio last week was 𝗁shipping, and that was up about 22.53% last week. And really, through the end of last year and even the beginning of this year as well, we've seen shipping prices continue to reduce. Obviously, the years previous, we had COVID-19 disruptions, which caused supply chain bottlenecks and caused the shipping prices to really spike for goods being shipped around the world. However, we are now back to pre-COVID levels in terms of the shipping rates, so they've kind of gone back to normal. And this did cause companies such as 𝗁shipping to have some reductions in their share prices. However, what we need to know is that the markets are usually forward-looking, and they're listening to what the management team are saying, and they're expecting that the shipping prices are very close to bottoming, and they have good expectations for the rest of this year and for next year as well. So we should see some improvements there. Also, 𝗁shipping has a very good dividend as well. And the third best performing stock last week was Everbridge, and that was up about 10.13%. And that's mainly because it's a technology related stock, and those performed very well last week. As we move on to our Death by Charts edition, I will go over 5 different charts in this. And really what I wanted to show you to the chart to the left is that the number of US bank failures since 2009. As you can see, in 2009, 2010, there was a lot of bank failures. We had almost 140 in 2009. 2010, we had 157, and that was off the back of the banking crisis and those subprime mortgages, etc., that were very tricky overall for the economy. And over the years, we've started to see those bank failures come down significantly, all the way to 2018, where we didn't actually have any bank failures whatsoever. And in the last few years, there's only been a couple of bank failures since that time. However, I do expect that number to increase over the next month to year, obviously depending on what happens with interest rates and how the governments respond to this banking crisis. But really, what I wanted to show you here as well was another reason why there is less bank failures over the last couple of years. Obviously, if interest rates were, at zero or record lows, that did obviously help. But we also saw that US banks are much well capitalized than they were previously. So there's been a lot of regulations, especially after the great financial crisis in 2009, 2008, 2009, really what they were actually forced to do is make sure that their banks were much better capitalized, and they had more money and reserves, etc., in the bank to stop these crises. However, obviously, we are starting to run into trouble again. But I think it just shows that the contagion is much less likely to be as severe as it was in 2008, 2009, because in general, banks are much better capitalized than they were back then. So I really wanted to show you this third chart to the left. And really what I wanted to say was, we know that last year, one of the mandates of the Fed was to try to reduce the overall balance sheet and the US Federal Reserve, their total assets. And they did achieve that to a degree. It wasn't anything unbelievable, but what we did see was that they managed to reduce that balance sheet by about 626 billion from April 2022 to where it peaked in March 2023. However, what we have seen just over the last week is that we've seen about 297 billion being injected into the market. So that's nearly like what 35% of what they actually reduced the balance sheet by in 2022 has been brought back into the market. So what we're seeing is a flood of liquidity back into the market, which is probably another reason why some of those stocks, especially technology stocks, did well last week. However, I expect that number to go up, and the main reason why I expect that number to go up is that the Fed are saying that these are not bailouts and they are not doing quantitative easing. But in reality, really what this is quantitative easing, because this liquidity is coming back into the market, and the only way that it can come back into the market is to be printed by the US and by the Fed. So I expect that number to come up, and it might undo all of the good work that the Fed has done in reducing the balance sheet. We're also seeing, however, banks have already been tightening their lending conditions, so they've been making it much more difficult for people to be able to borrow money and have to have more collateral, and there's basically been more stringent in approving loan criteria. Lastly, I just wanted to talk about the expectations for the Fed funds rate. And as I mentioned, the market is pricing in a 0.25% increase at the next Fed meeting, and that is the most likely scenario, although they could leave it flat. But what they are pricing in is they are pricing in that from kind of June onwards, that the Fed could start to reduce their rates. And we're talking 0.25% cuts meeting upon meeting, but they're talking by January 2025 that the interest rates could be cut down all the way to 2.75%. So it's a little bit strange for me, and I'm not sure if it's going to happen this way. And the reason why I think it might not happen this way is because I know a lot of people are panicking at the moment about the banking crisis. However, it's very uncommon for the Fed to come in and say, look, we're going to increase interest rates at the pace that we've been increasing them at. And once we get to our maximum rate, we're going to cut them straight away. I mean, usually when you're tackling inflation, what you need to do is hold the interest rates at those higher levels for a longer period of time, really, because there is a lot of lagging effect in those inflation numbers. So I'd be surprised if they cut so early, but we could potentially see a interest rate freeze, especially over the next few months or so. But let's see what happens and how those next inflation numbers and data come in. So I just wanted to talk now about crypto news and views, and crypto has had a really great week. Really, Bitcoin has had a really phenomenal week last week. Other altcoins did okay, but what we are clearly seeing is we're seeing a flight to safety of people moving their funds into Bitcoin because of what's happening with the banks. A lot of these banks are only have insurance for funds up to 250,000. A lot of companies and even individuals have a much more than that in their banks. And we're seeing some of that being converted into Bitcoin, which is obviously a finite supply, and you don't need to worry about counterparty risks such as banks. So we're seeing a lot of inflows into Bitcoin. I still think Bitcoin is taking a very similar pattern to what happened in 2019. We saw a big rise up in Bitcoin, all the way from about 3,500 up to about 12,000. I think that was in a space of kind of 3 or 4 months. And I'm expecting as kind of a similar increase as this banking crisis intensifies. And obviously Bitcoin was made with this type of situation in mind. So I'm expecting us to take out that $30,000 range within the next couple of weeks. It could be as soon as this week, to be honest. I still don't think we're going to make all-time highs in 2023. I think that's very unlikely to happen until the next halving, but I do think we could have some quite significant upside from here over the next few months as people worry about the banks. So another thing I wanted to talk about is there was a very daring bet from the former CTO of Coinbase. And what he's actually bet, he's bet 2 million, so 2 separate 1 million bets with different people that Bitcoin will go to over $1 million over the next 3 months. And that number just seems absolutely insane to me. But really what he's pricing in is he's pricing in that there's going to be hyperinflation in the US dollar, and that this banking situation is going to get a lot more messier, force the Fed to continue to print money, inflation is going to go through the roof, it's going to spiral out of control. And really what will happen is, if that was to happen, was that all assets would go up because the dollar would weaken in purchasing power. So you'd see oil go up, you'd see stocks go up, you'd see real estate go up, and you'd especially see Bitcoin go up because it's finite supply of only 21 million. So I don't expect this to happen, to be honest. I think what you need to bear in mind with hyperinflation is serious. Hyperinflation is defined as being over 50% rises per month on a monthly basis. So that would be absolutely out of control if that happened. I don't expect that to happen. It might happen one day in the future, many, many years from now, but I think it's very improbable that will happen over the next 3 months. And he's probably trying to get publicity for himself and to create headlines which he could use in the future. So although it seems very nice, the hopium of it going to hit $1 million in the next 3 months, 1, is very unlikely, and 2, if it was to do that and there was hyperinflation, that $1 million wouldn't be worth a lot, considering that the purchasing power has been hyperinflated away. We've also seen over the last couple of weeks, 𝘃𝗶𝗀𝗲𝗃, the CEO of Binance, has said that he is going to deploy over $1 billion in Bitcoin, BNB, as well as Ethereum. So again, there's expected that there's going to be a lot of liquidity coming into the market. I believe he hasn't started to deploy that $1 billion worth of stable coins that he previously had, which he wanted to put into those 3 different currencies. But there are certain people that are tracking his wallets to see when he does buy. So that could be even more liquidity coming into the market. And thirdly, just what I wanted to talk about is Arbitrum, which is a layer 2 Ethereum scaling solution that's currently being worked on. And it has been announced that Arbitrum, people were waiting for them to drop their airdrop. and for them to release the token for trading. And that is expected that will happen in the next couple of weeks. And anybody that has been interfacing with the Arbitrum network are expected to get an airdrop. Why am I talking about that? It's not on eToro, but I think what you need to know is that when people, especially big projects like Arbitrum, which I expect it to be a very big project in the future, when they release an airdrop into the market, what you're really doing is creating liquidity. A lot of people will sell off those airdrops. Those airdrops will then be deployed into Bitcoin, Ethereum, other altcoins as well, which could have a boost for the market, because as we know, crypto is very affected by liquidity. Lastly, what I wanted to talk about was and show you a chart of, which is the Bitcoin dominance. And over the last couple of weeks, and actually since the start of this year, we've seen an increase in the Bitcoin dominance. And I think the main reason why I think this is happening is I still think we are in a risk-off market. So you might say, well, why is Bitcoin pumping? Well, the reason why Bitcoin pumping is because it is being seen as a life raft, as a store of value, because people don't want to keep their money in banks. Doesn't mean that we've necessarily entered a risk on market, which I don't think we have yet. So I think that's why we haven't seen the altcoins really break out like Bitcoin has. And that is why the Bitcoin dominance is set to increase. However, I do think altcoins eventually will catch up and will start to reduce that Bitcoin dominance. But I think Bitcoin dominance could spike for the next month or two, whilst fears are very high of this banking contagion. So thank you very much for listening to my video today. I really appreciate all the new copiers and followers who are following my portfolio. So thank you very much. And I'm glad that this year has started off really well so far, and that some of you long-term hodlers of our portfolio are starting to bear fruit. And I expect us to have a continued great 2023 as we progress through the year. If you haven't done so already, please make sure you join my Discord group. Really amazing group of people. We're regularly talking about the markets. You can ask me any questions you have at any time, and we just generally have good chats, and everybody is really great in there, and you can talk with like-minded investors. So everybody have a great week ahead, and I'll talk to you all soon.